Boy, it sure seems like summer, right? Things heat up. We get some geopolitical risks and tensions. Crude oil takes the headlines. The market barely moves whatsoever at all in a very small range, very light volume. And the temperature finally went up here in Utah. So it looks like it's summertime. So we're going to break down, not like Friday, the S&P 500 didn't move hardly at all, but other things did. And so we're going to break down what did, how that impacts our posture, how it ties in, and then we'll take a look at a trade idea to take advantage of this kind of short-term weakness we've had in the markets, in particular one sector, and see how we can trade that. So let's go ahead and get started. Today is Monday, June the 24th, 2019. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, well, let's go ahead and get started and take a look at the S&P 500 on the Market Forecast Indicator. The intermediate line continued higher despite the small pullback. And keep in mind how small this pullback is. Again, it's like, yeah, it's a two-day decline. And yeah, we fell a whopping 5 points today. But we still are not even sniffing the 23% Fibonacci retracement, much less the actual retracement zone down here between 28.20 roughly and 28.75 or so. So, and the near term line's down. It's still in the upper half of the chart, but you've got 1, 2, 3, 4, 5, 6, 7 days now, so that's normal. The momentum line is giving us an intermediate confirmation signal with the strong bullish posture with the oversold momentum line. It is oversold to an extreme, so it's a little bit of a concern. This is a red flag, so we'll keep our eyes on that to see whether or not it leads to the near-term line also falling into the reversal zone, which would be the sign that this bullish posture is most likely going to turn bearish. As of right now, it's a red flag and something we need to pay attention to, but I don't see it necessarily leading to a bearish move. Now, keep in mind that this bearish divergence, lower highs on the near-term line with higher highs on the index, the target for that is the low point in between. So right here, that's the low point that corresponds to this near-term low in between the highs. Well, that happens to be the top end of the retracement zone where there's going to be support. And then you can see, the first high is actually where the 23% Fibonacci retracement is, which we can hit here. And the Fibonacci fans kind of give us an idea of when we might actually hit these levels if we continue to pull back. Would be kind of ideal if we did. But if we don't, we don't, right? That's just the market. That's just kind of how it's been doing lately. It just moves on its way higher without very much of a pullback. So we'll keep our eyes and see how we do. And just don't be surprised if we don't pull down here to what it would be by the end of the month. So by next week, or this week, excuse me, a few days, if we pull down to 28.72, which would be a pretty significant decline. It'd be 28 points, 45. You're looking at about a 73, 75 point roughly move to the downside. There would obviously be support in that area, and it would not be that significant of a deal. I mean, it would nullify this retracement, this near-term retracement, but it's just, again, not that big of a deal. We'll take a look at more of the short-term outlook here in just a second. We'll go ahead and remove that drawing. Let's take a look at the Dow Jones Industrial Average. You see the same thing, the divergence, the intermediate confirmation signal. So we're getting this pullback. Of course, the target for the pullback would be a lot deeper. It doesn't mean we have to get down there. And then finally, the NASDAQ Composite, same pattern, same oversold, more of an extreme low on the NASDAQ. And then finally, the Russell 2000, which dropped more than a percent and a quarter. Its near-term line did drop down here to bearish levels. So the Russell 2000 is kind of giving us a bearish look from a short-term sentiment that may lead to more bearishness in the other indexes too. So we want to keep our eyes peeled for those. You can see, let's remove this one now and draw a new one. If we are in the midst of a new decline on the Russell, then we're at the support level now at this 1530 area. If we cannot hold this 1530 area, then and we'd break through, especially 1500, probably going to be bearish in all the other indexes too, and now we're bearish. I don't expect that to happen, But that's definitely something to keep an eye on that would change the posture from where it's at now, and all these these indexes, at least on all the other ones, from a major or a strong bullish posture to what would be a bearish one. If I were to pull up the Bollinger Bands for these and look at the same kind of level on IWM, you can see we're kind of hitting this node as resistance. That's why it's not easy for it to break through. There's a lot of people talk about how the Russell's underperforming. Well, there's a reason why the Russell's underperforming. See, the S&P 500 is broken through all this volume, and it's up above, it's above its value area. We're just pulling back to its value area. That's why it's can't go down very far. A lot of volume below it. The IWM, the small cap index, is much different, right? It's still coming up with all this overhead supply above it. So it's having a hard time getting going. If it gets above here 166, then away it goes from there. But until then, and really until it breaks up above, if it gets above 158 or so, then it's got some room to run to get to this point, to 168 essentially. But that's, there's a reason why small caps are underperforming. It's because it's got a lot of resistance overhead that the S&P just simply does not have. I mean, you look at the NASDAQ composite and the same thing. It's broken through all this volume resistance, unlike the small cap index. And now it's above all that volume. It's got very little volume resistance now to the upside. All right, before we look at some other charts, I invite you to subscribe to our YouTube channel. Mouse over our logo right here on the bottom right corner of your screen, then hit that red subscribe button that pops out. Or you can hit the red subscribe button below the video. Either way, that will notify you when our videos are posted. Click the thumbs up icon down there. That tells us two things. Number one, you got something out of our video today. Number two, you want us to do it again tomorrow. So a quick way to give us feedback. We look at that every day to see what you're thinking. You can do it with one click. You can do that right now while you're watching the video. Also down there, comment on anything that stood out to you from our video tonight. Join our daily Market Outlook email list. There's a link up there in the top right corner of your screen. Click that link to subscribe. Follow me on Twitter for more content in between videos from day to day. And join our Market Outlook community that we've created on Facebook. All right, eventually, to be able to watch the full version of these videos like you're seeing now with the trade idea and all the intermarket relationships and technical analysis that we talk about day in and day out, you want to subscribe to our site. That way you'll be able to see pages like this, which you can see now, everybody can see now, but that won't be necessarily the case in the near future. So to subscribe to our site, you can do it for free. Click this image right here. That will subscribe you. We'll also be sending out that link to people on our email list, so make sure when you do subscribe that you keep that box checked to join our email list as well. That will make sure you get notified of the full versions of these videos, like I said, including the trade ideas day in and day out. Also, while you're on this page, engage with us on social media. That way these social media platforms will make sure to keep sending you our stuff, and then we try to make it very easy for you. Click on this heart right here. That will open up this window. You can like tonight's Market Outlook tweet, and then click on this image. That takes you to your Facebook account. You can like tonight's Market Outlook Facebook post. Again, the more you engage with us there, the more they'll make sure that everything we send will show up in your timelines. All right, back to our charts. Let's take a look at the long-term view of the S&P 500, and you can see, of course, very small range today, as you'll really see here in just a minute. But, it's the Heikin-Ashi candles that matter the most, especially early in the week. And you notice, for us to get any kind of lower shadow on this week's Heikin-Ashi, we'd have to get down here, below 28.88.11. So we've got a long ways to go. That's the open there. That's when we might get a little bit of a transition. Also, keep in mind too, when you're bullish, you typically get higher highs here. Of course, that's just the higher high in the actual index itself. So 29.64, that's about 20 points away to the upside. We'll see if we end up getting that. Of course, you can see at the bottom is the MACD, and it's relatively high. It's been higher. We've crossed above this before, coming off of this 2016 low. We got kind of to this level. We pulled back, similar to now. Retested the 200-day moving average and bounced, crossed back through this 3% mark, and then has gone, took off and stayed above 3% for quite a while. So, and even over here, after this intermediate pullback, we stayed above 3% for our typical intermediate run. So don't be surprised. We're high, but we're not like abnormally high, as you can see in context. Over the past 10 years, we spent a good portion of time above this level on the MACD. In fact, most of 2013 and 14 into early 15, we spent above this level. And just about every time we have a bullish run. So we're high, but we're not that high. We can definitely break through here into a new run. After this kind of year plus consolidation that we've had here since early January 18. Let's take a look at the 3 green arrow charts. Of course, we got 3 green arrows and the rising moving average, so it's green. We're trading above a rising moving average, so that looks good. If you look at the 2 lines, of course we are, again, remember this green line now takes us to July expiration based on the volatility of where we were at on the 18th of June, just for some context. And you can see now we're even coming in below that pace, but keep in mind that that's our pace. So, while we might be up and down, watch to see if we trade up and down around that particular line. The MACD itself on a daily basis is pretty high, so not surprising we'll get some weakness. We are relatively high above the 8-day moving average too, so we can come down just to the 8-day moving average, hit it, and then continue to ride it up while we diverge. So this is kind of our first surge from below zero to a relatively high level, and now we'll watch to see as we kind of stay up here, and we ride this rising 8 and 17-day moving averages up. Of course, breaking below either one of those would be another red flag, which obviously we're not doing either of them right now. The Russell 2000 was the one that was giving us that red flag on the you can see it came down to not only that Fibonacci support, but also the 17-day moving average. So, and it did not get very bullish on this surge from below zero. So watch this to see, if we don't hold this low today and bounce off of it tomorrow, and we break down even further, and then that's going to be even more of a red flag for the strong bullish posture that we have across the major markets. All right, now let's take a look at the intraday chart and look how small and tight that range was. So, very, very, very small range. In fact, let's get that new Heikin-Ashi open. SPY, and we'll pull up the Heikin-Ashi candle, and the open today was at 288.94. So let's go back over to this chart and move this purple line to 288.94. So again, this is where we need to get below to get any kind of lower shadow at all. That also happens to be last week's low. So you notice, it would take a significant move for us to get any kind of lower shadow at all on today's candle. Of course, if there's a major, if we got down to 284.70, we got a significant lower shadow, then we'll probably end up with a similar size upper shadow, and that could be an early transition candle to a reversal. So definitely something to keep an eye on as you're looking for, even though my expectation is bullish going forward, doesn't mean that we can't look for signs that would alter that expectation, any red flags that turn into something. Because if you have an expectation and you maintain that expectation no matter what the price does, then that can be a recipe for disaster. So you have an expectation and you look for anything that would suggest that it's not meeting that. And we're getting little red flags in the small cap index, but as of right now, nothing else really major that would suggest that we shouldn't be bullish according to what the market forecast is telling us. Especially when you look at today and again how light the volume was here. Let's go to SPY here. You can see the range just over a point, extremely small range, 47.5 million shares trading hands. Just for some context on that, 47.5 million is way below this already low average. The range of 1 point is also way below this already low average. Not extremely low averages here, but they're lower on the 52-week range and they're falling. And of course, we're breaking below the 1% mark on the ATR to price ratio, this kind of relative ATR. And then finally, if you take a look at the volatility index, it held up today. Despite the really small range, it held up. It's still in the neutral zone. So again, we're not too bearish. We're not breaking back into the bearish range, but we're also not breaking down below into the bullish range either to signify that, you know, this bullish train's leaving the station. So still kind of stuck in neutral as we are working around what is currently a near-term pullback. You know, we'll see if this near-term pullback sets up in another day or two, and then we bounce into the end of the week up towards new highs, up towards new near-term highs, and get this train out of the station that currently we're kind of stalled in with the engine running, but we're currently still kind of stalled in this station, ready to take off. All right, now is your time to vote on what you think about that technical outlook that we just came up with. We're going to talk about what's driving the market today, and we're going to look at a trade idea. But before then, click that link that's popping out there. It opens up a poll. Then hit either agree or disagree. What do you think about that take? Which is essentially that we are still leaning towards a strong bullish posture. We are getting some short-term weakness and a few red flags that as of right now are just pointing us towards a near-term pullback and nothing more. Something to keep an eye on that in case it does turn out to something more. But as of right now, is this leading us towards a near-term pullback, a new low point, a new near-term low point to bounce off of, and then move towards up to new near-term highs and then get this train out of the station. So do you agree with that take or not? Let me know in that poll. If you don't, comment down below on what you think, what your take is, what you're based on what you're seeing, and be able to share the charts or describe the charts that you're seeing that gives you a different outlook than what we just came up with through our routine here. All right, now let's take a look at what's driving price action today. Of course, the big news of the day was Iran sanctions from the U.S. administration and its impact on these different asset markets. Of course, did not really touch the dollar. In fact, fell. But look at gold. So gold and long-term bonds were outliers to the upside, as well as foreign bonds here. But gold and long-term bonds were outliers. Crude oil started the day weak until these sanctions were officially announced, and then it rallied and finished the day with a strong move to the upside. International stocks, you can see, at least developed markets were really the only major equity market asset class that was positive. Emerging markets were down, the S&P was down, and of course the one outlier to the downside that fell all day long was the Russell 2000. So we saw its chart. I do want to take a look at the dollar index here and what it's doing. Let's take a look at this trend strength indicator. And of course, we'll talk about it, the impact of this. But you can see the dollar continuing lower here today. See, this is a weekly chart. Let's go to a daily chart. Continuing lower here today, down to 96, or even breaking down here or Friday, continuing down. Its trend strength indicators are strongly into this moderate bearish trend territory. So again, if I were to kind of give you some context on what kind of bearish trends can come out, you can see how noisy. Anytime it's below 50 on this indicator, we're pretty darn noisy. And what little tiny moves we had were very short-lived. But you can see what the trends look like when we get on this, and then the noisy periods you have in between. Well, we've been in this really strong and for a long time noisy period, but with a bias to the upside. This noisy period, which really is extended since July of 2018, so for about a year, with with a few trending periods we've had, that was bullish, this one was bullish, that was a longer bullish run, and then this one was bullish. We had a couple of bearish, 1 and 2 right here. For the most part, we've been pretty strongly bullish with this upward bias until this lower high point that we just created, and then the breakdown below this trend line, this kind of ascending triangle trend line, and the failed breakout above 98, a fake out, which can be significantly bearish itself. So we're kind of at an important level at 96. Breaking below 96 sends us down to 94, and then of course breaking below that sends us down even further. And the impact of this bearishness on the dollar, and what might, in fact, I think more bearishness is being priced in on the dollar than going forward from here. The gold market, you can see breaking through last week. This 1350 plus area up to 1400 and following through with a strong gain today. A strong bullish trend now on the weekly chart. So really kind of taken off here. And again, for some context on this move, I mean, it's a very, very strong move that it has here. Significant move, breaking through this kind of 1380-ish level and getting to highs that we haven't seen for a while. So again, it's not necessarily in and of itself a causal relationship, but more of a reflection of the bearishness in the dollar and how bearish we can be, and not just bearishness in the dollar, but also bearishness in yields, which fell more down closer to 2.2%, continuing to work its way lower and setting up the table for the Fed to be accommodative. Or at least less restrictive, and then of course to make some rate cuts. And we've seen rate cuts in the past with the markets near all-time highs. In fact, I tweeted something out today, or retweeted, excuse me, from Ryan Dietrich here, that since 1975 there's been 26 times where they've cut rates, where the S&P was in this case up more than 15% year to date, and that continues to be bullish. And you can see from a new high standpoint, we're not anywhere close to being exhaustively bullish here. So it's not just because we get the one rate cut or maybe two, like we got. In fact, we got 3 in the 94-95 period, and there's a lot of things that continue to point towards that 94-95 period. Was the other thing I retweeted out here. Here we go. This other period where, you know, we're up 17% relatively early in the year, not the earliest, but these other years you can see some of these years have been, you know, there's the 1987, of course, very famously bearish in October of that year. But some of these years you can see have been really bullish from that day, in this case June 20th on, going forward from here, including this year, 1995. So where the Fed... where the markets felt that the Fed raised rates too much in 1994, and they got, like I said, 3 cuts in mid to 95 to early 96. So very similar circumstances here. It might not lead to the exact same result, but you can see that it's a similar environment that can produce similar types of results, based simply off just one thing. Obviously, there's a lot more than just one thing that impacts the broad market. But the dollar falling down has a significant, well, it can have a significant impact on that. We see that. And the other thing, too, is commodities making a run. They haven't really made that significant run to say that this is the last stage of a bull cycle, something similar to here, where the stock market peaked over here in 2007. It continued higher. If this ends up, the stock market's, peaking here, we're not even close to a peak, kind of an intermediary peak where we can continue to go higher even while the markets might be weaker. So that's a general key. In fact, you're kind of getting a little bit of a triangle forming on crude oil that you could eventually break out of. So we'll keep our eyes on that in terms of a risk appetite, and that has an impact on emerging markets. Emerging markets similar to small cap index, kind of a risk asset class, and you can see on its weekly chart starting to get its own, very close to its own moderate trend on the daily chart does. Again, almost, really, it's got to get above 2, but really, really close to its own moderate trend. So emerging markets are trying to, it started to make a bullish trend here, a little bit of noise during this period, some ups and downs. We had this pullback, and with that fake out on the dollar to above resistance, now that the dollar's breaking back down, it looks like emerging markets, these international markets, are starting to take off again. You can see on this chart we have green all across the board, all these numbers. Germany just barely getting above 50, and it's still got the yellow moving average. UK is not above 50 yet, so it's got light green shading, and it's still got a red line. But for a lot of these, especially Russia, and you can see China, South Korea, these kind of Brazil, these main large emerging market economies, are showing strong bullish patterns here, similar to what we're seeing on the S&P 500 now. You can even see Canada with this link to commodities there in Italy, kind of the emerging market, so to speak, of the Eurozone. India is the only kind of major emerging market that's kind of lagging behind a little bit. It's pulled back in the last few days back towards its moving average, whereas some of these others haven't quite pulled back nearly as much. All right, from a sector standpoint in the U.S., again, the theme is this pullback, right? And the biggest areas of pullback, and not surprising, energy, with that initial weakness in crude oil, and plus just the overall weakness in energy that continues to really lag behind. Here is the 6 month, and you can see how the energy sector has really been lagging. Let's just go here to today. Take a look at today here, June 24th, and we'll go 10-minute chart. You can see energy stocks started the day weak and stayed weak, but you can see, you got consumer stocks up here to the upside, staple stocks holding up, communication services, technology, utilities were outperformers for most of the day before pulling back, and then consumer discretionary really coming down here below the market. Not something we would expect in a decline. In fact, we might be able to take advantage of that. With this idea that the markets are it might be sitting on a support and ready to make a near-term low and continue higher. That brings up opportunities in stocks that also might be pulling back themselves towards a support and ready to make their own move higher. So one stock in particular is the home builder stocks within that consumer discretionary. They've been doing relatively well, trying to get ready to break out, and that's DHI. You can see DHI has had the strong green shading, which means we've had the strong bullish posture, the intermediate line of the green line rising. You've got the short-term sentiment pulling back with the potential of rising higher. If you were to take a look at its 3 green arrow charts, it's actually got 3 red arrows today, which on a bullish trend can serve as a potential bullish signal when you get the 3 red arrows. Of course, the nice thing about this is if it continues to break down, we are already down, so we can keep our losses really small. The idea here is we'll either bounce up off of this, as you can see, something similar to this, or we won't. And if we don't, we get a small loss. If we do, we get the nice, good kind of cup and handle pattern that can lead us to a breakout in this real estate sector, which it had previously been doing pretty well on a relative strength basis. If you take a look at the Bollinger Bands for DHI during this pullback, it's essentially failed to get out of the value area in its first attempt. You've got strong support right below where we're at with this volume node. So that's why I say it's going to be hard for it, not impossible, because anything can happen, but it's going to be hard for it to make significant moves to the downside from here, and easier for it to bounce off of here and make a run. Like I said, this kind of cup and handle pattern to the upside. Let's see what the pullback looks like on the DMI indicators. You can see that the orange line, which is the negative line, has gone up above 20, but not above 25. The blue line is dropped down below 20. So there is a pullback here, but not a bearish. We'd be more concerned if this orange line crossed up above 25 for the opportunity for a bearish move, and it hasn't done that yet. It's actually in a nice setup for what could be a bounce up from here. You look at the long-term outlook of this, and you see it's we're above a rising 50-day moving average. We've traded down towards this. That PPO down there on a relative basis is not very high at all. There's been a lot of times it's been a lot higher than this. It is relatively high, but this is not even close to being an extreme peak. So in other words, there's opportunity for this to make a run after this pause up towards its all-time highs that it hit in that really early period, and you've got some kind of inverse head and shoulders pattern that may develop out of this. So that being said, we can say, okay, well, let's look at potentially buying a put option or a call option like this one that I did here right before the market closed, so that we can be able to follow this, buying at the money and putting half of that at risk. All right, so you would make your trade look like this. Give me 1 second to pull this back up. So it would look like, get rid of that one. Let's come back here. 50 days out, right? Well, because we're going to buy a long option here. Right click on the ask price that we want to buy. We'll buy a custom with a stop order, and we'll set our stop order at half of that price. So what that would be 167, if I can do the math right in my head. 167, and we'll put that as a GTC. And so there we go. That gives me some wiggle room. Of course, you know, if I get out earlier than a 167 loss, and let's analyze this trade, and we'll get rid of these other positions from other classes on here. And if I were just to analyze this trade, and you can see set slices to break even, you can see we have to get up above 46.70 or so. But if we were to come down, let's take a look. If we were to break down here below this support level that we have, that kind of significant volume node, the point of control, you know, if we were to break down, let's say 42 into this 42, below 43, if we were to break down below $43, that's right here, and let's say it does that tomorrow, down to 42.75, I'd be down about 80 bucks out of a total of 234 that I could lose. And you remember, a half of that, 167, is what I'm position sizing, or at least what I'm putting my stop order to lose and position sizing for. So I'd end up with even half the loss of what I'm position sizing if it fell down below that significant support. While if it does go up and it makes even just a 1 standard deviation move between now and August, the expiration date, then you can see I've got a potential reward of $385. It's a pretty decent reward to risk ratio if I'm only risking, you know, 167 with my stop order, which is similar to like an airbag in a vehicle, or even just $80, or half of that if I end up getting out early on a break of support. If it doesn't bounce immediately like we're speculating that it will based on these technical patterns that we see. So you can see how the setup works and how there's easily a decent reward to risk ratio to make out of this. All right, well, that wraps us up for today. Now you've heard from me. I want to hear from you. Let's keep this conversation going in our Market Scholars forums, particularly in our Market Outlook forum. There's a link right there. Click on that link. That will take you there. Remember, you have to subscribe to our site to participate in that forum, but you can do that for free. But let's keep this conversation going. If you have any questions or comments about the video today, open up a new thread and reply to anybody else's thread on any other comments or questions that are out there as well before we do the Market Outlook again tomorrow. So as always, thank you very, very much for watching our video tonight. Remember to subscribe to our YouTube channel, hit that thumbs up icon, and comment on our video. Follow us on Twitter for more content in between the videos, and then join our community. Our website at marketscholars.com, which you can do for free, as well as our community that we've created on Facebook with that link I shared with you earlier. Again, have a great rest of your evening, and we'll see you all tomorrow.